what are tradies waiting for to say, gee, do we fire up the engines again and push to $140 yen? Or is it kind of just a stasis period where there's not enough reason to sell it and not enough reason to buy it?
Look, I think the issues with yen are quite clear, and markets have talked about it for a long time. It's a terms of trade issue, and it's also an issue of monetary policy divergence. But we are taking a slightly different view here. Our view is that dollar yen is largely driven by real yield differentials, and we are sort of the view that long-term yields in the U.S. Have already peaked. So 10-year just shy of 3.5%. We think that was perhaps the peak. And with that view, we actually think there's probably more downside for dollar yen over the next few months, not upside. So tactically, as we get closer to 140, we would look to get into bullish yen positions.
Why do you think that the yield differentials have peaked? Be a little more specific for us. That seems like a pretty powerful point.
Sure. So we are actually much more bearish on global growth and on the U.S. growth. So we are actually looking for a recession starting both in the euro area and in the U.S. By the fourth quarter of this year. And if we are right on our recession call, I think that would mean that the limit for the Fed to hike rates is also going to be quite limited. Sure, we might see a couple of more rate hikes, but they're unlikely to push rates significantly beyond what markets are pricing now. And as recession fears grows, I think that will also lead to some amount of safe haven bid for long end of the U.S. Treasury curve.
Divya, where does that take the U.S. dollar trajectory then?
Well, I think the U.S. dollar still looks very strong to us. Essentially, the dollar is deriving support from multiple sources. So you have the interest rate differential support. So 2-year nominal yields in the U.S. closer to 3.5%. I think that's very attractive. It becomes very difficult for investors or corporates to hold anything else but the dollar. And that's the feedback that we are hearing from our corporate clients across the region. At the same time, there's also a terms of trade angle where, the US dollar is a lot more resilient to higher energy prices, unlike, say, the euro and yen. And at the same time, the recession fears probably mean that the counter-cyclical attributes of the dollar will perhaps get enhanced. We'll see some safe haven bid for the dollar as we go into a recession. So multiple sources of dollar strength, which is why I think the dollar will perhaps remain quite resilient more broadly.
When it comes to emerging markets, obviously the yuan seeing its own idiosyncratic pressures, but do you see a 7 handle on that depending on what the PBOC does or doesn't do? And what are the implications for the rest of emerging FX in Asia?
Sure. For the yuan, we do see more upside for dollar China in the third quarter. And essentially, I think it's a combination of structural, cyclical, and seasonal drivers which are pushing up dollar China. So on the structural side, of course, growth, we know some of it is, of course, because of the zero COVID strategy. But some of the elements of the growth slowdown that we are seeing in China can also be traced to structural factors. At the same time, on the cyclical side, the monetary policy divergence is very clear. We had the MLF rate cut a couple of weeks back versus what the Fed has been doing. That is leading to some amount of capital outflows from China as well. And on the seasonal front, we are still in the midst of dividend outflows season from China. And that, we think, continues till the end of September. So more pain ahead for the renminbi. I think 7 looks quite likely at this point. But by the end of the year, we still expect some amount of recovery in the renminbi based on a very strong balance of payments.
Divya, I love one of your headlines on one of your reports. Asia foreign exchange out of the fire into the frying pan. There was a lot of discussion about that out in Jackson Hole. How the dollar's strength, even if it doesn't continue to move higher, is still putting pressure potentially on currencies. Who's most vulnerable?
Look, I think Asia overall looks quite vulnerable to us. I think the hawkish Fed and the combination of slowing external demand, fundamentally, that's very negative for Asian currencies. But I would also make a couple of more points. First, I think the buffers for Asia going into a more challenging period seems to be quite low. So if you look at interest rate differentials, 2-year Asia versus the US, that is at the lowest level since the global financial crisis. At the same time, if you look at reserves measured in months of imports, for Asia overall, ex-China, that is also at the lowest level since the global financial crisis. In fact, it's even worse than it was during the taper tantrums. So buffers are running low. At the same time, I think the FX policy for central banks, which has so far been to focus on imported inflation, which is why central banks have been quite happy to be selling dollars, we think that will change as external demand slows down, export picture starts looking more challenging, then I think we will start seeing a lot more focus on export competitiveness. So central banks will not be willing to supply dollars as they have been. So I think overall it still looks a very challenging picture for Asia for us.